Good afternoon and welcome to FBN Charting Points, a technical look at ag markets. My name is Brian Como. Today is December the 19th. We'll have one more of these before Christmas. But today I do have to be out the door a little bit sooner today. So some of these charts are pulled before the close. Usually I always wait till after the close. The close is happening as I am recording this, and not much is changing as far as what I wanted to talk about today. So I think we're safe, but I just wanted to kind of give you the heads up. I'll give you an idea of what we're going to do here today in just a second. First, I'm going to read through some of these disclaimers. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties express or implied as to the accuracy or completeness of the statements or any information contained in the material, and any liability therefore is expressly disclaimed. Past results are not necessarily indicative of future results. Okay, what I thought I would do today is I'm just going to run through a couple of charts here on the majors. And what I mean by majors is corn, soybeans, Chicago wheat. I'm going to talk about Minneapolis wheat and canola. So those are the crops, and I'm going to take a look at the nearby contract, and I'm going to take a look at the new crop contract, and just kind of give you an idea. A lot of these markets are kind of in sideways patterns right now. And so I kind of wanted to give you an idea of where I thought some of the trigger points would be where you may want to take action. You may be behind recommendations, you may be at recommendations, but looking to make the next, take the next action, or you may be looking for some actions to protect yourself on some new crop bushels. Either way, I thought I would go through each of these and kind of point out some of the levels that I think are important here. So here is the nearby corn, or the March corn. As you can see, we've been tracking really closely here to the 20-day moving average, kind of jostling back and forth below the 20-day moving average. The 50-day moving average is interesting. It looks like the market has a number of times tested the 50-day moving average, and that is kind of now a short-term resistance level. That's this green line here. If you follow my mouse along here, this green line here, you can see back in late October, we broke below that 50-day moving average. We have not moved above that since, although we've had some very close tests of that resistance. As a result, I think that 50-day moving average is or may be important. And so you might want to keep an eye out for that. A breach or a test of that may be in the cards at some point. If the market rallies, it's likely to come back and test the 50-day, as it has almost every time it's rallied, but it has failed every time. So if you're looking to take an action in the short term here, selling the 50-day or as it approaches the 50-day is probably a good idea. As you can see, those days never really closed near the 50-day moving average. So putting targets in place and managing them, if you're an active manager of your contracts, putting a limit order or a market order in there as it approaches the 50-day moving average, which of course will change every day. So you do have to monitor it relatively closely. Is probably something you want to do. There is some support here that I want to watch out for as well that we are approaching today. That's a low of 470.5. So if we start to break down below that, I would be concerned about further downside. So if you're looking to alleviate some risk using a floor pricing strategy at somewhere around that 470 level with strikes at 470 or some kind of floor at 470, that would be a good idea. Selling that 50-day moving average right now at 490. If you're really feeling if you're really feeling up to it, you can try to sell this 5, some, or even somewhere in this 510, 521 October high, somewhere in there, placing targets in there if it does rally past that. But right now, that definitely looks like an outside range at this point. And it does look like corn continues to be trending lower. Let's see here. I didn't pull the right chart. So let's this is a March CBOT. Let's, you know what we're going to do? We're just going to go and pull one right now in real time. Okay. Or maybe that was maybe I missed late. Oh no, here we go. Okay. Let's see if we can get this into the presentation here where it should be. And then we'll get you back on track because, you know, that is how I like to operate. There we go. Okay. Now let's see what we can do here. I'm giving you a little behind the scenes look here. Okay. Here's our December corn chart. As you can see, we moved lower to test some support today. That support exists right at 502, 502 and 3/4. So we're about a cent away from that support. I would look at protecting this at this point. There are some bits and pieces of support a little bit further down. So, you know, it's possible that we will break below, you know, this, 502 area and test one of these lower levels closer to $5. But, I think that area is worth protecting. And if you haven't added some coverage to your 2024 stuff yet, as per the recommendations, then it might be a good idea to do that with a floor pricing strategy. I do think, obviously we'd rather be selling kind of the upper part of this range, this short-term range here that we've seen over the last few months. But if we do start to break below these levels, it could signal some further downside. So I would err on the side of protecting these values as opposed to waiting for a bounce up into this area at this point right now. But you could achieve both of them. You could add some floor coverage here and then continue to add coverage as we move up into the upper end of this range here as well. So these are pretty good. There's carry in this market. These are pretty good values. We're seeing over $5 for December corn still. So that's, nothing to shake a stick at. There's, 20 cents in here. It may not be worth, risking a whole lot to try to eke out the top of this range. That's why I would err on the side of using floor pricing strategies at or near these support levels that we're seeing right now. All right, moving on to soybeans. Again, like I said at the beginning, a lot of these markets are just kind of in this middle of the road area. Some are trending sideways, some are just in the middle of ranges. We have an inside and an outside range here on Jan soybeans. Right now, if I'd be looking at protecting prices, I'd be looking at protecting, this inside low here of about $12.92. I would be looking to sell this inside high at about $13.44. And then the outside ranges here are $12.70 on the downside and just under $14 on the upside here. So I think action could be justified in any one of these levels, right? So actually, in protecting, as the market moves away from this support here at about $12.92, adding floor pricing strategies at $12.92 is a way to kind of cheapen it up and give you some disaster protection without spending too much money. And then as we move closer to this area, that's where I like using flat sales, cash sales with a plan if the market continues to move above those levels. As you can see in soybeans, there's a bunch of stepped resistance up here as well. So unfortunately, it's hard to call pivot points even on a breakout of the previous high, but that's where the inside and outside is on this range right now. So layering into some floor pricing strategies at this $12.90 area, or even this $12.70 area, might be affordable enough, and still give you full potential upside in this market if it is going to continue to rally, but also kind of keeps your risk off the table if the Brazilian rain situation continues to put pressure on these markets. Here's the, what it looks like for new crop. Similar thing, right? We're right in the middle of this kind of high low from October to November. We do have an inside range here as well, just below 1260. Call it 1258 and 1292 here on the top. So that would be your inside outside range on soybeans, or your outside range, sorry, on the downside would be 1230 to about 1320 or so. Very middle of the road. And so, what I would err on the side of here is potentially protecting more of this inside, this 1258, this 1260 area on the inside, and maybe have some disaster protection down at the 12, down here, or even in the 1250 where the 200-day moving average is kind of tracking right now. So I like those. I wouldn't necessarily, look at necessarily selling the pop up to $13. I think if you have floor pricing in here, you have some flexibility to test the upper end of this range. But I would be an advocate for selling. As you can see, it looks almost like a triple top here in July, September, and in November at these 1320, 1325 areas for November beans. So I definitely wouldn't want to be taking any risk much above that. So if we can get the market to come back into that area, I think we should be participating more heavily. But protecting this 1260, 1268 or 1258, 1260 area and the 1230 area right now might give you the breathing room to be able to do that confidently. All right, here's CBOT SRW wheat. As you know, this market has kind of been attention of short sellers and short covering rallies and whatnot. Again, we're right in the middle of ranges. We're converging into some moving averages here, but we still do have an inside outside range of about 558 and 650 here. So again, actually, what I would be looking at protecting these prices right around the $6 area here on the March wheat right now. I think that if this does look somewhat positive in that it did make a new high and then came down to make a higher low. So if we can kind of push this back up to the 650 area and above, we might get another little extension here, if even only to the 200-day moving average. But I like protecting this 602 at this point in time. Your disaster right now is at 560, so I wouldn't want to be taking any risk south of 560. So make sure that you have a plan if the market continues to fall towards that area. Adding floor pricing strategies right now into that 560 area would probably be relatively affordable and would give you some peace of mind if there's going to be some volatility to come in this market. Here's what this looks like for December. Again, middle of the road, just like a lot of the other commodities. This previous low is probably worth protecting. That's at 645. Again, there is a number of tops that come in here on the top side. That I'd call that 679 to 680 on the top. I would be a participant or a seller as we moved into those areas, and then the real cheap but kind of disaster protection coverage right now would be down around 620. That's 617 that low got to, but you could probably find some good floor pricing strategies with a strike of about 620. So right now I'd probably be looking at floor pricing strategies with 650 in mind, maybe with 640 if you wanted to make it a little bit cheaper. Your disaster protection right now is at 620, and your selling opportunity right now is at 680 for new crop Chicago wheat. All right, here's Minneapolis. Again, trading right in the middle of the range recently. We've got 697 on the bottom here as the outside range. The top here that we saw in early December is 747 and 3/4. So again, if you're looking at that, you might want to stay away from putting targets in right at 750. That would mean you'd have to breach the previous high in order to reach that. So I like to stay, below that 745, 740, somewhere in that area, and then you want to protect, somewhere near this 710 area, or for sure this $7 area. Actually, you may just want to circumvent this whole thing and just say, hey, I want to protect the $7 area. Find some floor pricing strategies with a strike or a floor in that area, and then it gives you a lot of upside potential as well. You don't have to worry about all of these little bits of resistance. You can just kind of wait and see what happens if the market decides to rally past the 750 mark. If it does, but then you're protected, yeah, as well if it decides to continue to float down. This market does continue to look, does continue to look bearish. It has not produced a new high, since July, so it is still trending lower. Although there is some neutrality coming into the bias here, as a higher low was also introduced. So to me, this chart looks more neutral to bearish at this point, and I would structure myself accordingly. It's pretty thin on the December Minneapolis wheat, but we still have some ranges here that could be worthwhile. There's obviously some carry in this market going out right now. We've got a good floor price right now for this market would be around 740, and a good selling opportunity would be around the 785 mark. It's right in the middle of that now. So putting a floor price around that 740 area and some sales targets in that 780 to 785 area, I think would pay some dividends. All right, last but not least, here is canola. So canola, I think, has surprised a lot of people in just how bearish it has been as of late. The crush market continues to be very strong, and there is new crush capacity coming online in the new year. If you think about this market as far as seasonality goes, it was very textbook. We saw a big run up in summer as the yield concerns came in. There was a reduction in July, as there is usually a bit of a mid to late August rally, and then you see the harvest pressure come in, which lasted all the way till the end of October. Now, in seasonal charts, you'll often see a rally in October and November, and that happened. And now we're seeing it kind of back off again as well. So very textbook seasonal pattern. I think more people were looking for bigger gains in this market from that post-harvest rally, which didn't come to pass. But I think that's probably what surprised the market the most, is just how muted this post-harvest rally was before further sell-off into the end of December. So this chart continues to look bearish as well. I think there's a very valid argument to protect some of these levels. We're currently at 60% marketed. I do still think that there is some opportunity with the new crush capacity coming on stream, and just some seasonal patterns in, as we move through, March, April, and May. May often give some very good selling opportunities as well, particularly if you can deliver in May. A lot of farmers are busy seeding or preparing in May. Roads are sloppy, road bans are on. There are some incentives, but if you can take advantage of those, we do want to hold out for some of that. We may play with another 10% here before that period of time, depending on what the market does. But I really don't think, I think we have the capacity to hold, the last 40, 30-40% into that spring summer rally. And that's what kind of the long-term plan is right now. So, looking at kind of sidestepping a lot of this weakness, although, the way this chart is structured, it does look like it could continue. Of course, we do have these lows in here at around 630 that may provide some support, but that's still $30 a ton lower than where we're at now. You could probably get some floor price coverage for that, or even less than that, and alleviate that risk altogether, but keep your upside fully intact as well. So I would take a look at that if you are, under some of the recommendation levels. Here is the January 2024 canola. It's kind of a similar, very similar pattern, right? This is the January. Actually, that's one other point I wanted to make. As far as where this could go here on the March, I did put this red line down here just south of 640 because the January contract is still alive and well. There is still open interest on it. There is a carry between the January and the March. And so what does happen sometimes is the January, this low here, 640, is an important one even for the March, right? So as low as the January goes, that does provide the opportunity for the March to get down to that level. That's what this red line is. Here is the risk. That's the market risk that the March contract fades down to where the lows of the January were. Now, realistically, is the low of the January in already? It may not be. We might see it fade further as we move through the rest of the year. There aren't that many trading days left in this in this month before delivery. So we could still post a new low on the January, but at the very least, the risk on the March is to fade to the January low, which right now is 640. Here's the January 2024. So again, it's a pretty bearish looking chart. One thing I'll show you something interesting here on the yield curve chart here, though. I do think that protecting these levels that we see these, previous lows, about 666 or 670 is probably the nice even number you'd find on some floor pricing strategies or some strikes, things like that. I think we're very close to that level. I would be protecting these levels. There's one important thing to keep in mind here, and that's the yield curve. This here is the November 2024 contract in the yield curve. So there's actually a carry right now all the way through the calendar, all the way to November. That is very rare. And generally, we see the November have a discount to it as we move towards the new crop. But I think this market right now is structured in such a bearish way that there's even a carry that goes into the November. So if this market is still bearish and it's going to continue to fall, I think all of these months here will continue to fade. But the risk is that the November falls at a faster rate at some point, so that we kind of get that normal carry that happens between July and November that comes into play. It also could be, it could happen that the rest of these months rise, but the November stays, relatively static or doesn't rise as fast. That would create a similar yield curve like this. But right now, the way the market's structured and the charting would suggest that this market has continued to fade lower, which actually puts the November a little bit more at risk of fading a little bit faster. So I just did want to highlight that. And that's not necessarily say that that's a guarantee, but that's just kind of historically what happens in these markets. And at some point during this crop year, I do believe that we will see an inverse between the July and the November. At this stage, I would put risk on the November, a higher risk on the November contract of fading faster than the opposite happening. All right, that's all we have for you today. Thank you for joining us. We will see you again on Thursday before we let you have some Christmas holidays. So we'll see you again next time. Have a great day.